Thank you, by the way, for taking time on a Thursday evening to be with me. We're going to have a lot of fun. You're going to learn a lot. And by the end of this, you're going to leave going, wow, that was great. And my goal is to make sure that I continue to inform, educate, empower you so you can continue to achieve your goals, reach financial independence is really what it comes down to. And ultimately, live in the life that you desire, right? That's what it's all about. So really, really excited to contribute to that. Perfect. We got some more people. So as people join, feel free, jump in the chat. Let me know where you're from. We got Noreen here, Chicago. I'm going to be out in Chicago, I believe, here in the next few months. I will be speaking at one of the Exit Realty events, I believe in May. Very, very cool. And let me ask you guys this, as we wait for more people to jump in, let me know what your goals are. Would love to hear from you. I know that this is our mortgage readiness workshop, so I'm assuming you want to buy a home, but expand on that. Let me know if you want to buy a home, if you're looking to refinance, if you're looking for investment property, let me know, what are your goals? What are you looking to accomplish? Awesome. That's perfect, Todd. All right, great. We got people in here wanting to buy a home, find a home. You're going to love what I go over here today. I mean, as you know, we're in a hot market. Every place in the United States, it's hot market, real estate market. And a lot of times, people are, as we know, we're having to compete in that home buyer's market. What we're going to go over here tonight, a part of what we're going to go over are some strategies, Jedi, super ninja Jedi type strategies that's going to be able to get your offer when the time comes when you start that mortgage process and you're out there looking for your home with your agent. Your offers are going to hold more weight. And so instead of it, when you're competing against, let's say, a stack of offers like this, instead of being, down here, you're going to be up here, right? And that's what it's all about. So can't wait to go over that with you all here this evening. Awesome. We'll just get started here in about 2 minutes. So thanks for being on early. Jump in as everyone. We got some more people coming in here. We got Nicholas in. We got a phone. I can't tell. There's a few phone numbers in, which is totally fine. Feel free to jump in the chat. Nicholas, anyone else there, let me know where you're from and let me know what your goals are. Would love to find out. You can either chat to everyone or you can chat me privately, whatever you prefer. I'm gonna have some Gatorade Zero in the meantime. So we got more and more people joining here. Awesome. Yeah, everyone in here. Well, it's awesome. Obviously, we're doing the mortgage readiness workshop. So wanting to buy a home is a key thing. There we go. There we go. Nicholas, I love it. Love that. Central Florida. Is that like is that like more of like the Tampa, not so much Tampa, but like Ocala area? Am I thinking right? Is that considered Central Florida? Nice. Very cool. Yep. I like Florida a lot. I usually go out there a few times a year. Oh, Cocoa Beach. Yeah, I've been there. That's awesome. Love that area. Very, very cool. Yeah, I went there, man, I think, yeah, I was in Cocoa Beach, I think about that area was probably about 4 to 5 years now, I think. And I'll remember I was out there with my family and friends. And for some reason, I decided that day when we hit the beach to not wear sunscreen. And that was a mistake. I looked like a lobster when I left there. So, and I'm Minnesota boy. I'm from Minnesota. I'm in Minnesota right now. So there's a huge difference, Minnesota to Florida. Oh, very cool, Todd. Raised in Jacksonville. Yeah, exactly. Got to screen up. I learned that the hard way. Perfect. We got a lot of people joining here. I love it. We're gonna have so much fun tonight. Thank you all for attending. I'm so excited to get started. We're going to get started here very, very soon. I don't want to delay too much. I just see that there's more people joining here, so I want to give them an opportunity. And anyone that joins a little bit late, no big deal. They can jump in and they'll just catch up to where we're at. Awesome. In the meantime, what I'm going to do is I'm going to open up my presentation and I will share my screen. So let's get that queued up here. Now, I have a few different versions of this presentation. So if you've joined me before, don't worry. You're going to learn something new. So don't worry about that. There's a few presentations that I have with this title, just because to me, frankly, it's all about credit, right? Credit and your financial wellness, financial positioning, understanding mortgage guidelines. That's what we're going to really dive into deep here tonight. But when we do that, that's what's going to get you to not only having ultimate buying power, but it's really going to assist you in creating more opportunity in your life. That's what it's all about. The more I can educate you, the more I can inform you and empower you to make better decisions. Not even so much better decisions. I don't even like saying that. It's about making decisions, informed decisions with clarity, because you know what you want, because you understand what it's going to take to get there. That's what it's all about for me. So let's go ahead. We're going to go ahead and get started. Okay. So if I just click on this and let's get going. So perfect. Tonight, we're going over this is our mortgage readiness workshop. So everyone that's working with us here at Credilife, if you're not currently with Credilife, I want to explain how we operate here. So our mortgage readiness workshop, this is something we host on the 10th of every month at 7 p.m. Central, 8 p.m. Eastern, okay? This will be consistently going all year at the 10th of every month. The reason why we do this is because we found, one, as we're helping people, new people, we want to have them join, want them to learn, but a lot of our clients active in our programs, this is information that you need to hear more than once. You really do. There's so many things. It's like one of those things that you kind of pick up something new every single time. So don't worry that next month in March, if you want to join again, you can 100% join again. And I encourage you to, because the more frequently that you attend these type of workshops, the more you're going to learn, and you're going to be able to start putting these things together, right? And it starts making more sense. I will also be emailing out here tomorrow, I plan to, our upcoming workshops, because we have a whole array of workshops that we're rolling out that started here in February that will be happening every single month on the same day of every single month, all at 7 p.m. Eastern, or 7 p.m. Central, 8 p.m. Eastern, okay? So look out for that. We'll be updating people, inviting people. That way you can attend more than once. That's what it's all about. Now, as everyone knows, I got 3 rules, all right? I got 3 rules. These are very important to me. Number 1, we're going to have fun. That's what it's all about. Anyone that knows me personally knows I love to have fun. Yes, I work hard. Yes, I have a lot of expertise in credit, financial wellness, banking, all that. But to me, I really want to empower everyone to have fun, because when you have fun with this, you learn and you get more excited to take action. Okay, that's what it's all about. So rule number 1, we're going to have fun. Number 2, this will be an interactive experience. So I encourage you throughout the presentation. I may not get to it right away. I will do a Q&A at the end, okay? I did open up the Q&A option within Zoom, so feel free when we open up Q&A at the end, go ahead and use that, put your questions in. I'll be answering those questions. But also throughout, I'm going to ask you all questions. So please get ready in the chat itself to engage, because there's going to be some things that I want to talk to you about to help engage throughout this to make it an interactive experience, okay? So that's rule number 2. You got to be willing to do that. Rule number 3 is take action. That is extremely mission critical. We got to take action, all right? Meaning, doesn't matter if you're in our program, if you're not, whatever it is. All I care about tonight, my goal tonight, is to make sure that I inform you and I motivate you so you can start taking action towards your goals. Constant improvement, constant forward motion by taking action. That's rule number 3. So I always like to ask this question. I want to get your minds thinking, right? I mean, think about this. Have you ever wondered what it would be like? We had someone here, they want to buy within 2 years, someone within 6 months, right? I mean, really think about this. Have you ever wondered what it would be like, what it's going to be like when you go out there and you start shopping for that home, right? You're out there looking for that home, your dream home. Have you ever wondered what it's like being able to do that with confidence, knowing that you're already pre-approved, you're in the best position possible, and you can get out there and compete in this market, right? Think about this. Start thinking about that. Start setting these goals, right? The more that you start to visualize this in your mind, it's going to keep you motivated to continue the path until you get there. Okay, so it's very, very important. And as I said, tonight, you're about to discover all sorts of ninja secrets, Jedi strategies, all right, surrounding credit, financial wellness, debt management, the mortgage process. We're going to spend a lot of time in the mortgage process. And we are also going to spend time on credit as well as financial positioning because they play such a significant role in the mortgage process. And I want to make sure that anyone that's working with me in any capacity, I want to make sure that when that time comes and you apply, you are literally entering into that where you're going to get the biggest loan, not to put you in financial hardship. I'm going to educate you on spending plans too, but I want to empower you to have more buying power, pay less fees, get better terms, and make the process smooth and easy for you. Because let's face it, the mortgage process is complicated. Now, my promise, I always like to give a promise. I've been talking about it already, but my promise is by the end of this presentation, and I want to hear your feedback on this, either via email afterwards or a chat, but my promise is by the end of this presentation, you're going to have the clarity in what you should be doing here moving forward, not only to maximize your credit score, improve your financial picture, but you're going to be able to move forward in your timeline, in your goal timeline to find that dream home. Okay, that's my promise to you. Now let's talk about the problems, right? Because we got some. One, people are overpaying, right? And that's the reason why I want to talk about this a lot. Mortgage, a lot of people are overpaying, meaning it's not so much about the interest rates. A lot of times people don't understand that credit, your credit score, for instance, plays a huge role in the mortgage insurance premium when you buy a home if you're not putting 20% down. All right. There's many different things involved. And so a lot of times people end up overpaying because of lack of knowledge of what their options are in advance. So even though you might be getting that interest rate, it seems low, a lot of times people are still overpaying when you could have saved money and had more buying power, okay? And that people are taking advantage of, in my opinion, because they're not being informed. That's my goal. That's my mission. I want to empower and inform everybody about this type of stuff, right? They don't know how to work. So that's a very big one. Anything around financial and mortgage, a lot of times they're built out in a way that's I would say complicated on the outside if it's not something you do every single day. Because of that, a lot of people don't know how it works. They don't know where to start. They don't know what they should be doing in advance. We're going to be going over that here tonight. System is built against you. That is true. Quite frankly, that is true. It's all about the banks. They want to make the most money. They want to mitigate the most risk. So that way, once again, they make the most amount of money. So a lot of times people don't understand what to do, how to play the game in order to get in a position where you save the most amount of money. Don't understand fees, points, and rates. We're going to go over that. Okay, that's a big one. Now, I understand how it is. I'm going to be real with you all. How are we as humans, right? When we don't understand something and we want something, we get frustrated, right? Stressed out. Maybe I'm paying so much in rent. Rent keeps going up. Rents are crazy right now too, right? My bills, inflation, all sorts of stuff, right? We start to stress out, might get a little angry. We're confused, like, what in the world am I doing here? How do I get this going? I want to buy a home, right? Sometimes that might lead to some doubt, might be burnt out. You're working every single day wondering, when is this going to change, right? So we're going to be going over a lot of stuff here today. I want to flip the script on this, all right? So what is the solution? We know it's going to start with better credit. So let's talk about Fico. You're going to really want to write this down. It's extremely important, the stuff I'm about to give you, okay? So make sure you got your pens and paper out, your pencil and paper, whatever it is. You got your iPad out, you're taking notes, you got your laptop, whatever it is. Let's take some notes. So first, what is a FICO credit score? So first off, FICO is its own separate entity. Okay, it's a company. They developed it's a risk mitigation score. It's a credit score, right? It's what lenders use primarily to help them make better lending decisions. Because once again, what do they want to do? They want to make money, right? So they need to be able to mitigate their risk to understand what's the probability of you paying me back. That's where FICO score came in, right? The credit bureaus are separate. So you have Equifax, Experian, TransUnion. These are separate companies, separate entities, for-profit businesses, okay? They're about data. FICO is separate as well. It's about the score. It's analyzing the data in the history to then put out a score. The higher the score, the lower the risk. Lower the score, higher the risk, right? So that could either lead to denials or they jack up something, pay more in fees, points, interest rates, whatever it is, okay? Now, let's talk about real quick what makes up a score. Now, in the meantime, I hope this works right. I'm gonna open up chat. I hope it doesn't mess anything up. Oh, perfect. Okay, it's there. I would love to hear from you all. When I talk about payment history, okay, what's the first thing that comes in mind? 35% of the score, FICO credit score, is payment history. What does that mean to you when it comes to the FICO credit score? Jump in the chat. I mean, on-time payments. I like it. Anyone else? I know that was a great answer. I know it sounds straightforward. So check this out. Yes, obviously on-time payments is a part of it. It is. But here's what it's all about. Payment history, the way FICO works, is we're not necessarily rewarded for doing something right, like making a payment on time, as we are negatively impacted by being late. So payment history, you almost have to think about it differently. Now, if I have nothing but positive payment history, that's a good thing. That's going to help the 35% of the score. But if at any point in my history, I show risk in this category, like a 30-day late, 60-day late, 90-day late, right? That's where we get dinged heavily, because it's about risk and it's the largest portion of the score. I think that's very important for people to understand. So it's not so much like, hey, I was a few days late. You know, your relationship with your creditor or lender directly is a little bit different. It all plays into this to credit. But they have like late fees, right? Hey, you were late a little bit, after a certain amount of days, you pay a fee. Now that's a contractual type thing between the lender and you. But when it comes to FICO and the way the bureaus work for reporting history, if you're 30 days delinquent, that's when it reports. Meaning you had a bill drafted, you didn't make your payment, the billing cycle went through, drafted the next statement, said, hey, 30 days late, you're behind, you owe us another payment here, you owe us some fees. That's when you're going to get dinged super heavy when it comes to FICO. Okay, so very, very important stuff to know that. Now, the next piece I'll talk about before we move on is amount of debt, 30%. This is more about revolving debt ratio. This is your credit cards primarily. Okay, credit cards, lines of credit. Now, who here knows? Jump in the chat. I want to hear it again. I want to see who knows this. What is the best ratio to manage your credit cards? What should your boom? Look at this guy. Look at this. Woohoo! I like it already. Oh my goodness, I love it. So yes, 1 to 3%. Why? I'm going to explain that. Now, this is specific to mortgage. Okay, I'm going to explain what that means here in a little bit, but I want to finish this. This is specific to mortgage. When you effectively manage your credit cards, meaning, you know, I have a $1,000 limit and you charge between 10 and 30 bucks, right? And that's it. And the reason being is that when you only charge that much, you stay in that ratio, and when they generate your billing statement and it shows, hey, $1,000 limit, $30 balance, minimum payment of 10 bucks, let's say, at that moment in time, when that billing statement is drafted, that's the information they send over to the credit bureaus. That's actually how it shows up on your credit report, your history. So what's beautiful about that is when you manage it that way, we have it report the perfect ratio that shows activity. It shows a low balance in comparison to the limit. Therefore, you appear, you're managing your debt. They have the data they need, you're active, but you do not appear to be dependent on it. Therefore, your risk is less, scores go up. I feel comfortable as a lender to lend you more money. Now, here's a who wants to know a ninja strategy here? Let me know, jump in. Who would like a little extra there? All right, Noreen, okay, I love it, love it. So check this out. Now, on top of that, as we all know, when it comes to the mortgage process, right? A part of the mortgage qualification process, if I could speak, is debt to income ratio. And the way that that works is when they pull your credit report, it's going to show all the minimum payments scheduled for every one of your debts reporting, as well as the proposed mortgage payment. They want that ratio to be a certain amount or less. Well, when you manage your debts at 1 to 3%, what do you think that does for you? Not only are we maximizing FICO credit score improvement, but we're also maximizing our debt to income ratio, keeping it as low as possible as well, which means you'll have more buying power. So what does that mean? Well, for instance, right now, based on the interest rates right now, roughly $10,000 in loan amount is about $60 a month. So that's huge. I mean, think about it. When it comes to credit cards, if you had, let's say, 4 credit cards, and let's just say hypothetically they're all $1,000 limits, and they all ranged around 700, balance, amongst it, right? So in the world of, let's say, money, that may not sound like a lot of money to some people. Like, oh, that's not that much. I can pay that down fairly quickly. Here's the issue. One, we're showing 70% utilization rate on all of them. Scores go down because of it. Even though that the amount of money per se may not be that much in the world of credit, it's about the ratios. So now we have a negative impact there. Now, let's say the minimum payment on all of those is $30. Well, check that out. What we say 4, so that's 120. I mean, right away, we've just lost $20,000 in buying power. You could have bought a house for $20,000 more in purchase price by paying those down. That doesn't even include the savings by having a higher score and getting access to better mortgage products and savings because of the credit score improvement, which could equal anywhere from $20,000 to $50,000 more. So that's what I'm talking about. These are some really cool stuff that people are not talking about today, and I want to make sure I educate you on. See, I got to step out of the chat. There we go. Now, what is buying power? Well, it's exactly what I've been talking about. To me, buying power is having the ability to pull the trigger on anything that it's about opportunity, being able to pull the trigger and take advantage of opportunities. That to me is buying power. No longer having credit hold you back. No longer having your financial profile or picture hold you back. No longer having lack of knowledge around all this hold you back. That to me is buying power, and that's what we're talking about here tonight. So why buying power? Well, we know it's all about opportunity. I mean, holy smokes. I think I chose a beautiful picture here. I like cars. I don't have cars like this. One day, I hope. But anyways, I mean, think about this, right? A lot of times for people to achieve their dreams, a lot of it, they end up through, financial discipline, yes, work ethic, yes, getting out there and making money. But the better you understand money and how you manage it is what opens up buying power and opportunity for you. Credit's a big part of that. So that to me is why buying power. And it's all about what you want, right? Everyone's different. So you have to be able to identify what's important to you and what you want. And then from there, based on this knowledge, put the plan into place. As we know, the time is now. We're going to take action. Now, I know we have some clients on here, but for anyone that doesn't know me, my name is Jared Havens. I'm a financial freedom strategist. I am the CEO of Credilife, a financial wellness company. We help people nationwide when it comes to credit and financial wellness services and programs. Our mission and my mission is to empower people. I want to assist people in credit and financial wellness to open up opportunity in their life. That's what it's all about for me. So I am the official speaker for the National Board of Attorneys here locally in Minnesota, and I teach classes to attorneys and actually judges, believe it or not, on credit and financial wellness, which is amazing. Certified in FICO, for any of you that's in the FCRA group, Jeremy and I, my entire team, play a huge role in that, mentoring people That's a big thing. Endorsed by the #1 Remax team in the world, and now as well Exit Realty worldwide as well. I love to teach. I love community service. So a big piece I do here locally is I teach at the Minneapolis Adult Learning Center, because I love to teach people about this, regardless of income, regardless of status. There's so much that can be done. And so I love the opportunity to do things like that. So now what we're gonna be talking about tonight, this is, don't worry, I'm not selling you guys anything here, but I like this term, the ultimate house buying system, because it really incorporates everything we do here at Credilife. It's a big part of what we do. So we have our Credilife VIP program. We have our ultimate house buying system program specifically. We have pro coaching. We have all these different programs. I'm not going to pitch that on you here this evening at all, of course, but I just want to make sure you understand it's all about, to me, if you're here to want to buy a home, I'm going to tell you guys tonight how the system works. That's what we're about to go over, okay? And why? Well, like I said, I'm here for a bigger reason, for purpose. I want to empower as many people as possible, thousands to millions. We've already helped thousands. I'm trying to get to millions, truly. I mean, think about it in the world today. There's a lot going against us, so to speak, right? And so my goal, I truly believe, by bettering people's financial position and opening up opportunity in their life, will have a massive ripple effect for the positive, okay? Not only for you personally, but for your family, your friends, your children. I mean, everything. That's what it's all about for me. So let's jump in real quick. I want to get right to the good stuff here. Sorry for moving forward. Okay, here we go. Now, I'm going to break down. Oh, look at this. We got the Chaz Giamona on. I love it. So everyone, write this down, okay? We're going to be spending a lot of time on these 7 steps, a few of them longer than others, specific to the mortgage process here tonight, okay? So 7 steps right now that we're going to be going over tonight in detail, some more than others. Number 1, start with the end in mind. Number 2, current assessment. That's going to mean something a little bit different here tonight for some of you. Number 3, credit improvement. Number 4, financial positioning. Number 5, get pre-approved. The mortgage process, how best to get prepared in advance so you apply with confidence, you get approved, and you save money. We're going to spend a lot of time on this tonight, okay? Number 6, find your dream home. Booyah! Number 7, close and celebrate. All right, let's get started. Now, we got to set goals. That's why earlier when we got started, we had Nicholas jumping in 6 months, Todd within 2 years. I know that we had Crystal jump in, wants to buy a home. You have to go set your goals, right? Now let's talk about this real quick. Goal setting. What is it that you want? I want to buy a home. Great. Why? Think about that. Why do you want to buy a home? I'm sick of renting. I'm sick of paying rent. I want to have my own home. Great. Why? Really dig deep as to why. A lot of times what you might find, give you an idea of my past, is for me, you know, I had a kid and I realized that I had to step up in life. You know, this was a little over 10 years ago. And I realized, like, oh my goodness, I have to take more responsibility. I have to do better. You know, I was renting a small, tiny apartment with my brother, not in a very good area because we were still bachelors at that point in our lives. And I realized, like, I had to figure this out, right? So goal setting is a big part of that, right? So with that, you have to understand why. Well, for me, it was, I wanted to have a nice place for my family. Now I have a larger family, so we continue to upgrade, right? But you have to set that. What is it that you want and why? Dig deep on the why with it. Trust me, that really helps. How are you going to get there? All right. Well, some of you in here, you've worked with Credilife. You're working with Credilife. That's a big piece. That's awesome. You're willing to invest into yourself to be successful. That's very important to understand that you're willing to do that, and that's a good thing. Are you willing to invest time, money? What type of resources do I need? Who should I be talking to, right? How are you going to get there? You might have to jump out of your comfort zone a little bit to talk to people to educate you, right? Get caught up to speed on how this all works like you're doing tonight. And I really appreciate that you're all doing this with me. I really do. So that way I can, you know, give you everything I got here to make sure you're successful. You've taken the right steps, right? And how you're going to get there. That's a part of it. Now, current assessment. Let's talk about that. Number one, current credit status. You got to know what it is. So let me ask you guys, everyone in here right now, how many of you right now maintain what's called online credit monitoring? How many of you monitor your credit and actually read or review your credit report? Nicholas raised his hand. Love it. Todd, perfect. Awesome. Crystal said me. Love it. Okay, great. So here's the importance of that. You have to have awareness. If you don't know what's on your report, how can you fix it? Right? You have to have awareness. And yes, I understand there's going to be a little bit of a learning curve there, right? You have to learn how to read a credit report. What's good, what's bad, what's indifferent, right? So with that, a lot of times, I'm sure some of you have seen that we talk about improving your credit profile, the strength of your credit profile. That's a part of it too. Here's a tip. I highly recommend that you write this down. Don't be a score watcher. Don't get me wrong, scores are important. I get it. It's a number that helps you understand where you're at in the race. I get it. But you don't necessarily want to be a score watcher because of this. What's the details within your credit report ultimately make up your score? Okay? So what I mean by that is you have to get more aware and you have to get more educated on what those details mean and how they impact the score. Like for instance, we talked about the management earlier, right? 1 to 3% and why. Those type of details, right? You have to understand the difference between installment accounts, and revolving accounts, right? So installment is, hey, I'm going to loan you $1,000. You're going to pay me back in installment payments over the next year until it's paid off for, whatever amount per month, and 6% interest, right? It's an installment account. Once it's paid off, it's done. Revolving is always changing, right? I can pull in, pay out, and it has interest associated to that based on the carrying balance. So you have to understand the difference here. Lines of credit, how does that work, right? Then you have to get deeper. What's the difference between a store card, retail card, secured, and universal or unsecured, right? So there's a lot of things there. So we will be hosting a workshop where we literally just teach you about that when it comes to your credit report, how to read it, how to monitor it, all that. So be prepared. We got a lot of great stuff for you here starting this month in February and on every single month. That's going to really empower you because obviously we're assisting a lot of you and working with you and doing a lot for you. But our goal is to make sure that you're done, and when you achieve your goals, this is a lifelong deal. You know what I mean? So the more that we can educate you, the better you're going to be in the future forever, right? So that's what it's all about. Understand your financial position. This is key too. So what do I mean by this? Well, you need to know where your money's going. What's coming in, what's coming out? Do I have any wiggle room? Am I spending too much money somewhere? Do I have a down payment ready? Do I not? Right? You have to really put this to paper, or you could use a software. We provide Money Mastery for all of our active clients. You get that as part of your service. It's an amazing tool. How many of you here have jumped into Money Mastery yet? Anyone that's in the program, let me know if you've logged into your Money Mastery yet. Oh, there we go. Crystal, I love it. Carrie, sweet. Thank you so much. I love that. Okay, good. That's more than I thought. Yeah, there we go. Chaz is giving you props. I love it. That's good. Heck yeah. Now that's important. This is something we provided. This is something that we take on that expense. We pay that. We don't charge our clients additionally for that. We decided as a company, myself as a CEO and my business partner, we decided, hey, you know what? It's so important that our clients have this. We got to make it work. And we already understand that, online credit monitoring is a separate thing, right? So you pay separately for that. We looked at it going, we don't want them to have to do this, then that, and then this. So we took that on completely without raising our prices, as some of you may have seen. And we did that because it's so important around financial wellness to understand you have to create a spending plan. You have to create a debt reduction plan. You have to create a savings plan, okay? Now, I will this month and every month, you're going to see it. I've decided to break it up into 2 sessions. I'll be emailing you guys. We're going to solely just dive into that. And every single month, we're going to assist you on that. How to make a spending plan, how to keep track of that, everything. It's going to be amazing. Okay. We've refined it. I know it's going to be amazing. And it's all starting here this month. So thank you. Now, know your timeline. We talked about that, the goal setting, right? Now, here's another piece that you understand. Hey, are you in a lease, right? When does the lease end? If you have to extend it, what does that look like? Extend it month to month or short-term lease, or do you have to do extension? Get those details, you know what I mean? That way you know in advance, because here's another thing that happens. You know, we've helped thousands of people. I've literally had conversations with a lot of people, and here's something that comes up a lot is, you know, things, you know, someone's working on it and they're really working hard and we're all doing our part. We're getting a little close to that lease time. The client reaches out and goes, oh man, you know, I just was really hoping we could get into it before our lease ends. And yeah, I just don't even know what my options are, you know, and should I extend, should I not? And I remind them, I said, look, remember, that's what it's all about. We got to know our timeline. Let's gather that information as quickly as possible to alleviate a potential stressful situation in the future. Because this is dynamic, right? We got to make sure that we're always on our feet on what we can do here. So the more informed you are and the more you start planning out in advance, things won't stress you out. What happens when you get stressed? We talked about it earlier. Get frustrated, we get doubt. Last thing I want is for someone to get frustrated or doubt while they're working with us because we didn't do proper planning and they prematurely cancel or something. We don't want that. We want you to be successful. What we do here and what I'm talking about here works. When you work it, it works, period, right? And so know your timeline. So we're going to constantly educate you on these really cool things to empower you. That's what it's all about. Now we got passion here. Credilife is the best choice I think I've ever made in my life. I love that testimonial. Now, credit improvement. We're going to break this down. I know a lot of you are working with us already, so I'm going to kind of be somewhat brief on this, but I really want to empower you, educate you, I should say, few more things, right? So building better credit. I want to spend some time on this. So we found, you know, when working with our clients, you know, that when we do an audit of your credit profile, right, your credit report, we're going to put together a plan to assist you in credit building. The goal of credit building is a few different reasons. One, obviously, we want to improve scores over time. Of course, that's one of them, right? More importantly, though, we want to strategically build credit in a way that's done to mitigate the amount of money that you end up spending, dependent on where you're at with your credit score. Meaning, let's say you're at a poor credit status. Well, the types of accounts available to you are specific to someone within a poor credit status. Well, the last thing we want you to do is get 4 credit cards, secured cards, right? That's not good. That doesn't help. Or get cards with really high fees or something that's geared towards poor credit. So we have to be strategic. So we're constantly vetting accounts to help you level up. You know, Finger Hut, you know, a lot of times people have come back, hey, why would I open up a Finger Hut? I don't want to shop there. Well, here's why. It's extremely cheap. Yes, they have a markup. I get it. At the same time, they increase credit limits often. There is no annual fee and there's no interest. And now, once again, it is built into some of the accounts, but there are some products on there that you can get that are extremely affordable. And remember, we're looking to maintain lower ratios anyways. But what's nice about that one is we're not getting put into, like, let's say a secured card that, you know, doesn't graduate and we're stuck in a secured card, right? So these are some strategies that we'll do. Here's another thing though, we'll get a little bit higher level. As we start to level up and we start increasing overall available credit, the strength of your credit profile improves and the types of cards you can now get are much better. We want to see our clients get unsecured credit cards, cashback rewards, flyer miles, not to put you into debt, but to open up opportunity in your life, right? So it's all about strategically building better credit over time. That's how you have to look at it. It's not a shotgun approach where, hey, I'm going to get 4 or 5 at once. We need to do it over time strategically. That has been proven to be the best, and you are able to access better forever types of accounts that don't hinder you. That's what it's all about, okay? Now, repairing past negative. Now, if you're working with us, we're working on that. That's a big thing. Investigation strategies, repairing our credit, any sort of derogatory. Now, remember, there are never any guarantees in this process. That's not how it works. Strategically, we're challenging the history of accounts in a way that's been found over time, the different variables, aspects, I should say, that have proven to work the best based on the type of account and its history, right? There's always analysis that we're doing real time with real people, and our goal is to investigate it in a way that's difficult to verify. At any point they're unable to, that's when the credit bureaus will remove it off the credit report because no longer verifiable or valid information. Okay, so we're repairing the past, right? You do this through letters. You definitely do not want to be doing this initiating online disputes. That is not effective, especially through Credit Karma. Do not do that, just because there's a lot of reasons why not to do that. But one, you lose a lot of rights. It's extremely ineffective, and they limit you in what you can say. You want to make sure that you use the right types of letters, the right types of formats. So people that are working with us in our other coaching programs, we have letter templates built out for you. We have all sorts of stuff that you can use. We make it as easy as possible to make tweaks to your information and send them out. You'll notice the structuring of those letters. There's a lot there, and it's on purpose because we have to leverage the law, and we want to be specific in what we're challenging and how. That's what it's all about, repairing the past. Now, one thing I want to talk about that real quick. Write this down. It's very important. Just because something's removed does not mean scores go up. This isn't talked about enough, and I'm going to be bringing it up a lot because it's beneficial. Don't get me wrong, when on the right account, but it does not necessarily mean scores go up. Okay, what does that mean? Well, here's what I'm talking about. For all you that's working with us, we have a very specific model: repair, build, manage. If we're not building, if we're not managing our debt correctly, repair will almost do nothing for you. It's just how it is, at least in that moment in time as it's happening. If I'm not building credit and I lack credit depth, and if I'm not managing my debt correctly, maybe I'm having late payments, maybe I'm not, maybe I have high ratios on credit cards, whatever it is. If I'm not managing my debt correctly, repair is not going to help, okay? What does repair do? Well, when we really hone in on strategically building better credit, that to me is future buying power, right? We're building the strength of your credit profile for more buying power in the future. And then over here, we're managing our debt correctly, right? We're working with Credilife, working the strategies, working money mastery. This is not an overnight deal, right? This takes a lot of practice, discipline. You have to learn, you have to be motivated to stick with it. And if you fall, get back up, keep going. It's all good. We're all human. But you have to manage, right? Learning how to manage your money, understand the importance of money, change your mindset around money, right? Why am I keeping my balances low on my credit cards? Because here's what it's due for me. Score is going to go up, lower my debt, DTI, debt to income ratio. I'm going to get a bigger home, right? The more it starts to click with you, that's the magic. Then when you put repair over here, if we're doing all this, now any success we have over here is a win because we have less negative weighing it down, right? But you got to do all this right. Super important. Now, financial positioning. So we got some people here on Money Mastery. I love it. Strategic debt management. All right, so let me ask you guys. So I know we got some people in Money Mastery. Now let me ask you this. How many of you are actively using Money Mastery right now on a consistent basis? Did you just start or have you been using it? Kind of give me an idea here. I'd love to hear it. Let's see if we get some answers. Just started, perfect, that's great. I think Carrie was in there before, right? Carrie? I think Todd said he was too. So, okay, YNAB, that works. That's fine. So, awesome, Carrie, 4 months, love it. Okay, now here's some things that I want you guys to to really hone in on when it comes to debt management surrounding spending plan. Okay. It's very important to consistently track your spending. So what do I mean? Well, one, you have to create your spending plan. So, I personally am not that a huge fan anyways, if we can avoid it, where I think it's important to take a little bit of time to analyze where your money is going by reviewing it, right? That's a big one. We really got to review where's our money going. And so that's wants, needs, everything. We really need to have a clear understanding, because I'm sure all of you have seen a lot of times we spend more than we realize. So that's very important to get that clarity, number one. And then what you do is when you realize and you put together that plan, right? Goal setting, we're working the plan now. We have to know, well, what are my goals? What does my financial picture need to look like for me to achieve those goals? We got to implement that into the plan. So what I mean is, budget, obviously it's considered a budget. I like the word spending plan more, but I always look at it like, okay, we have category expenses. And so as you start going down and looking at your category expenses, you want to start tracking that. Anything that happens, not like fixed, hey, every single month I pay roughly this in utility, I pay my auto payment, my student loan payments, that can be tracked monthly, but it's extremely important to start, if you can, almost like daily tracking. That's what's nice about Money Mastery in the app, is you can actually pull up your spending plan and track your spending. So let's say you go to the gas station, you fill up your gas tank. What's nice about the Money Mastery app is when you pull that up, you can actually put in, hey, just spent $34, whatever it is, filled up the rest of my tank, $60, $90, $100, whatever it is, it depends on the type of vehicle. You pull that up, you put that in, it automatically updates and reflects what you have left in the month to spend in that category. That to me is critical. The more you can make that a habit for yourself, it's going to really put you in tune with where your money is going. It's extremely beneficial. I understand that at first it might seem a little burdensome, like, oh my goodness, I'm not used to that. But wow, when you start, you quickly realize where it's all going. I mean, how often, think about this in your life. This has happened to me many times in my life before, right? I sit there and I look at my account after I've paid my bills, and it's like, where'd all my money go? Right? I don't even know where it went. People say that all the time. Where did it all go? Right? That's because microtransactions, all the little things add up. They really do, right? So the more in tune you get by daily management at first, I think is critical. I would do it, right? And then on top of that, if you want to buy a home, you can actually put a category in there for savings, right? Where you start allocating, based on that spending plan. If you have any wiggle room there, you can really start working that either towards debt reduction, savings for down payment. There's a lot of really cool stuff that you can do in there, okay? Let me jump over here. Focus savings, we talked about that, right? Savings for down payment, spending with the plan. That's what we're talking about, is understanding where your money's going, why it's going, what it's going to do for you, how it's going to help you get to your goal, how quickly, and afterwards, it really opens up all that clarity. You can really have fun with it, actually. You really can. So William here, I was able to buy the home of my dreams. Love it. All right, let's spend some time here. That's what it's all about right now. What time is it? 7:43. Wow. This is amazing how quickly this goes. Is everyone having fun? Let me see. Show of hands in the chat. You guys having fun? You got with me still? Oh, yeah. There we go. We got the raised hands going. Oh, yeah. Here we go. Look at that. Love it. All right. Perfect. Well, thank you. So, oh, yeah. Keep on. There we go. I will. I'll keep going. So understand debt to income ratio. We talked a little bit about that earlier when it comes like debt reduction, the importance of debt to income ratio. So, it's important to know like around debt to income ratio. I'll break it down for you one more time, because I feel like this is something that if someone doesn't understand it, it can be confusing on the outside. So remember, when you apply for a mortgage and they pull your credit, right? And they have your income documentation and all that stuff, they're going to be putting that into the application. They run the numbers, right? So your proposed mortgage payment, tax, insurance, all that, boom, PITI is put into there, right? They call it PITI. So your proposed interest, taxes, insurance, all of it, boom, that's your proposed future based on what you're looking to get. And then the minimum payments that reflect on your credit report. So the debts that show up within your credit report will show up in the debts section there in the application, along with the minimum payments scheduled. And those two combined with your income, that's how they factor in debt to income ratio. So they want to make sure, hey, your income and these expenses, they're proposed and current, they're 45% or less, right, of your gross earnings, your gross income, just a gross income, okay? So that's what they're going to be going off of, because obviously there's taxes, other things involved, right? So that's what they're going to be going off of. What's not included? Cell phones not included, utilities isn't included, childcare is not included. There's a lot of things not included. A lot of people don't know that. So it's really specific to your income, your gross income, your proposed payment, and what's showing up on your credit report. That is how they're going to factor in debt to income ratio. Now, having all of your documents prepared in advance, this is key. I can't tell you how often I hear, before I move forward, I'm going to answer this question. How about student loans? Are they included? Yes. Student loans are included. We're in a very unique time because of what's been going on with the CARES Act and COVID, obviously, and the forbearance and all these different things happening around student loans. So here's how that works, and this could change. But if they were, before the CARES Act and forbearance, what they would do in most cases is they would take either a percentage. It used to be 2%, a lot of times it's more now, 1% of the loan balance, or the scheduled monthly payment. But they, like, a lot of people are on term like pay as you earn. Any income driven repayment option typically will not work because it doesn't amortize, meaning it's based off income. It's not on an amortization. So they don't accept that payment. So they'll take 1% of the loan balance and they factor that as the monthly payment towards debt to income ratio. If it's in forbearance, they're going to take the 1%. I would say a lot of times right now, the 1% is probably going to be the rule of thumb. There are some unique conventional loan products out there that will accept different types of payment. One thing we've done with our clients actually is, and I would highly recommend, there's a lot of caveats to this, so I don't want you to jump to this right now, but I want to educate you on some options. So basically, there's a plan called, you have, like, I look at them like conventional repayment options for your student loans. So you have fixed, you have your extended termed ones with fixed payments, and then you have the one that's graduated, the standard term or extended terms, longer terms, right? I believe it's up to like 20 or 25 years. And so a lot of times you could do that graduated payment that starts out lower, but it does fully amortize and pay off at the end. And some underwriters will actually accept that based on the mortgage product, will accept that number instead of the 1%. And a lot of times that number would be lower than 1% of the loan balance. So those are some cool things that you can do in advance. But the reason why you would not maybe want to do that is just because, let's say you've been in an income driven repayment plan for some time, and you potentially qualify for debt forgiveness, right? Because the way the forgiveness works, at the end of the plan, the term of the plan, whatever additional principal and accrued interest is still due or outstanding, I should say, is then forgiven. That's how the debt forgiveness plan works. So if you've been in that, if you were to switch to conventional and then switch back, which you can do in theory, well, you lose all the qualified payments that you had before by doing that. So you just got to map it out. You want to work with a professional. We help people with that, help navigate through that. We have services for that, but just, I want to educate you. There's a lot of different things around it. I'll answer another question here, and then we'll do some more at the Q&A at the end. Do annual bonus count towards income if it's variable? That's a great question. Typically, from what I've seen, is if you have a consistent bonus over, I believe, might be different based on mortgage loan product, but I'd say I'd err on 2 years, 1 year for sure, but more than likely it might be 2. They want to see some consistency there. And then what they're going to be doing is they're going to be going off of your year-to-date income. So they can help factor in that, 2, that's what I thought. So they can factor that in, mathematically what your income average is out there. But as long as you have that and there's consistency behind it, they're going to be able to take it. So now having all your loan documents prepared, what does that mean? Well, when you go into it, you want to be prepared. They're going to need pay stubs. The rule of thumb is 30 days worth of pay stubs. So if you get paid bi-weekly, you don't give them just 2, you give them 3. That's actually important to know. So if they're needing 30 days or more pay stubs and you bi-weekly, it's dependent on your pay schedule. You got to give them that or more. So have that ready, right? Your tax filings, you got to make sure that you're up to date on taxes, right? Want to have your filings ready. If you're a business owner, this is a big one. If you're a business owner, a lot of times as a business owner, right, you want to take advantage of tax mitigation, right? Hey, I want to lower my tax liability as much as possible. Remember, as I said before, when they talk about debt to income ratio, they're going off adjusted gross income. Well, if I'm doing all sort of mitigation, I bring that down to a lower adjusted gross, that could impact your loan qualification greatly. So think about this now. If you're self-employed, think about these things now. Connect with a tax professional so you can better plan on how to do that so you can qualify for the home that you're looking for, right? Asset documentation, right? 401k, right? That's a big one. If you have any sort of retirement, that's an asset. Your bank statements. Here's another really solid reason, and I'd say another ninja strategy, Jedi strategy. I wish I was a Jedi. I would say the better you can get at managing your bank account now is critical through a spending plan. Because if you can show a history of better balances, that's very important, okay? You definitely don't want to show any sort of overdrafts, obviously. That's a big no-no. So the better that you can manage your bank statements, that's critical. Your money, right, with your bank, you want to show a strong history, right? That's key. You want to have your bank statements ready. A lot of things like that are going to be very important. Here's another thing, okay? Get connected with a trusted mortgage professional, meaning you want to work with someone that's experienced and gather these types of documents up front. Highly recommend it. Here's why. There's a lot of loan officers or lending institutions out there that will pre-qualify you. Hey, give me your let's pull your credit. Oh, your scores look good. You know what? Let's go ahead and what's your income? All this okay? Hey, you're pre-approved for 380,000. Have fun. Boom, rock it out. Well, they haven't seen your income documents. They haven't seen your assets. They haven't preconditioned. They haven't pre-underwritten almost your loan. There's a lot of things that can cause a hiccup there and play a huge role in either being denied potentially or changing what you're pre-qualified for in a loan amount. This can cause a significant amount of stress on someone. Let's say you go out there, you have your pre-qualification letter, pre-approval letter, you're out there with your agent, you're out there competing in this market, your offer gets approved, you go back to your loan officer, then they start asking you for your income and all these different things. They come back and go, ooh, I didn't know that. Man, yeah, I know you said your income was X, but looks like your bonuses here have only happened for a year and not 2. We can't accept that. Actually, so you no longer qualify. Debt to income ratio, it's actually more about 280,000. This happens to people all the time. All the time. So you want to connect with a trusted loan officer, mortgage professional that is going to gather these documents up front. You want to know what you truly can be approved for, and you're almost like you say, I'm looking for a conditional approval. I want to know what I can be approved for real. That is critical. That alone right there is going to save you so much stress and really open up a ton of opportunity. And on top of that, now that type of a pre-approval, you can leverage that in this market when you're placing offers with your real estate agent. A lot of times loan officers now, to assist agents in the market, they'll reach out and let them know, hey, look, I got everything. I got their income documents. I got their assets. Credit looks good. I got everything here. So that's what it's all about. That to me allows you to compete and do a power offer, right? It's very, very important. As Chad's saying in here is very, very important here too. strong offers, inventory is low, demand is high. That's what it's all about. Oh, I like the gifts thing. You want to make sure you keep a proper paper trail. What does that mean? You have to be able to effectively document where all payments, you have to document anything that came in. So you have to source any deposits, I should say. So if you receive a gift to help you with down payment, it has to be sourced. And I believe on both sides, has to be sourced. Okay. So that's very, very important. Now, finding your dream home. Let's talk about it. Have your ducks in a row. Well, that's what we just did. We are out there. We're conditionally approved. We got our ducks in a row. We know what we want. We have our timeline. We're informed. We're working the spending plan. We're ready for the down payment. We're rocking. Your ducks in a row. And let me tell you right now, if you do all these things I'm talking about, you're going to be in a significantly better position than most out there working with agents right now, especially in first-time home buyer situations. Use our proven system that I'm talking about here tonight. This is really going to help you. What I talked about before, I want to break this down, some numbers for you in addition. So here's another thing you're going to want to write down. Mortgage insurance. Okay. So I want to educate you on something. No one is taking FHA around here. That's true. That's what Jazz is saying. Here's something to consider. So FHA financing, right? That's mortgage-backed financing. So the mortgage insurance associated to that type of loan is higher. So when you're approved, you're going to pay more for that. Why? Because backed by the government, if you're to default, the government bails out that lender, basically. It lowers the risk for the lender to lend you money. That's why the credit score requirements are typically a lot lower, right? Because there's less risk involved. But you pay more for that. Even though you may qualify for some of the lower interest rates that you see out there, you're still going to pay a lot more for that type of loan. Now check this out. Let's say you're sitting at that 640 middle score. You've been working with us. We're working the plan. We're paying down debt. We're doing all the things. And we hone in on more of like a 680 middle score. Maybe we push a little bit longer for a 700 middle score. Now we're entering into a very good area for conventional lending. That's really the idea, I'd say, for most clients, if we have the time for it, right? If we have time, let's push for it, of course. But check this out. Look at these numbers. So based on the average loan amount, I'm just going to go off of, we have people here in Florida. We have people here in Chicago, Minnesota. So let's just base it off of like 400,000, let's just say $400,000 loan amount, right? Or purchase price. Well, you have minimum down. Let's say you're doing 3%, 3.5% down, 3% down, 5% down, whatever it is, that remaining amount. You don't have 20%. Well, by achieving that higher score, 680 to 700, one thing to consider, every 20-point increment up to 760, it's going to better your interest rate and terms associated with that conventional loan. And then on top of that, your mortgage insurance premium goes down significantly. On average, people save by that what I'm talking about right now, from FHA to conventional with the higher score, on average, people would save close to $400 alone a month. $400 a month alone by having a higher credit score, conventional lending. It's huge savings on, like, let's say a $400,000 loan. Well, we talked about earlier, every $10,000, roughly $60 a month, roughly, depending on the interest rate. That's basically where it's at right now. That's a significant amount of increased buying power by doing that. Or by not, a significant decrease in buying power. Now, it just depends. There might be times it makes sense because maybe you're on a strict timeline or whatever it may be. You can always refinance down the road, right? There's opportunities. However, if we have time, it makes sense to achieve those types of goals in advance. All right. So that's what we're looking to do for our clients here, if at all possible, right? It's all based on your timeline, of course, your situation, timeline, all the different things. But if we can push for a stronger credit profile, better credit score, and really put our financial picture in the right place, look at all these areas we've identified to increase buying power for you and save you a ton of money. I mean, it's amazing. You got your power offer ready. You're working with an amazing loan officer. Now check this out. I want to let everyone know about this real quick. So We have a relationship with Exit Realty nationwide, in fact, worldwide. But here for everyone that's in the United States, it's more applicable. So anyone that works with us, and if they're wanting to work within our Right Way to Real Estate network, a lot of that right now on an agent side is Exit Realty based on the location. They will contribute $500 as a buyer's rebate on every transaction for you just by going through this network. They don't increase cost on anything. You're going to save, you're going to get all the bells and whistles, and you get money back at closing. And on top of that, we have mortgage partners throughout the US that will, in addition, they offer, basically what they do is they use a little bit of their basis points, or they're called. They will contribute as well to help reduce some of the closing costs within your loan. So absolutely amazing stuff. Costs you nothing to do that, and only pays you to do that. And you're working with trusted people. That's why we did this. You're going to work with a trusted loan officer. You're going to work with a trusted, expert, experienced real estate agent. That's what we want for you, to avoid the issues I talked about earlier. So Melissa, Robert, we got our first home. Now close and celebrate, right? Let's have fun. So you're in the home, you save a ton of money, you're informed. Really, this opens up opportunity for you as well. You may find that the more you get into this and really understand the power of money and really how to leverage it, you might start seeing yourself investing in real estate. There's a lot of opportunities and things like that too, but all starts with your goals first, right? So close, celebrate, peace of mind. You got what you wanted, you saved money, you're furnishing the home because you have great credit, you know how to manage it, you know how to pay it down, you have a housewarming party, you get your friends over, family over, you're showing off, right? That's what it's all about. So we got here, let me move this out of the way. It's in my way here. The property I call home, right? We got Maya here. They have given me hope. Melanie says, true professionals. And I want to ask you right now, will you be our next success story? That's what it's all about. So want to open up the stage here. I want everyone to be our next success story. Okay, let's open it up. Ask some questions. I want to hear some feedback. Was this information beneficial to you? Did you learn a lot? Do you have any questions? Lay it on me. Oh, love it. Nicholas, he goes, heck yes. I love it. I can't wait to see that testimonial. Oh, I love it. Very beneficial. Thank you so much. Yes, with an exclamation point. Booyah! That's what it's all about. I love it. So thank you all so much. You're all going to get an email from me automatically after this. Please reply to it with any feedback. I'm always looking to improve. We're always looking to improve to make sure we're constantly delivering the education that you need, so that way you understand it, you can put it into action, right? Please give me feedback. If you have any questions, reply back to email. Let me know. My team and I will reply to it. I want to thank everyone for taking time this evening. I truly appreciate it. I get it. It's a late night Thursday, but just knowing that you're here shows me that you're motivated, you're ready to succeed, and you will be our next success story. Thank you so much. Have a great night.